in many ways, I've always thought that the term fintech was misappropriated. First of all, it's a portmanteau word, right? Financial technology, fintech. And it was narrowly applied to some parts of banking, notably retail, to direct-to-consumer, to certain parts of financial services, i.e. lending, savings, and so on and so forth. And that's very restrictive because the financial services industry is vast. It is comprised of many ecosystems which themselves are extremely complex, extremely important for our economies, right? And capital markets and asset management, to speak of only two verticals within financial services, there are many opportunities, many interesting and many exciting things. And to me, operational efficiencies, new business models driven by B2B models for institutions in these respective markets are extremely interesting from an investment perspective, and I'm a venture capital investor, so I'm extremely excited about those, and probably more so than the rest of fintech, which is kind of like, in quotation marks, more traditional. So that's what we are going to explore today. And each one of you are in a completely different market, but they're all absolutely fascinating, and they all have their points of friction and their opportunities, and they are to be approached in different ways. So I'd love for each one of you to introduce yourself. Let's start with Mr. DriveWealth. And then if Nick is not here, then we'll jump to you, and then we'll have Nick afterwards. That's fair? So, like an introduction on you, and then on your business, because maybe the audience does not necessarily know the business that you're in.
Right, so, as we've watched this whole digitization of finance over the last number of years really take hold, what we recognized a long time ago was that the underlying infrastructure to support it wasn't really there. We've seen a lot of great things done on the banking side in terms of banking infrastructure, but brokerage investment infrastructure is really still pretty much legacy and pretty old, to be quite frank. So what we wanted to do is basically create a whole new level of infrastructure to support all the cool things that, in terms of product, that these new digital players and neo-challenger banks, obviously a lot of the digital wallets that are coming around, which is a major global trend, even debit card swipes and putting investments into that. How do you power that in a really efficient way? Because the way we see the world today is that the world's moving really towards very efficient, cost-effective microtransactions. That basically consumer behavior and investment behavior are going to get linked through a lot of different means, and eventually AI is going to have a big play in that and become much more efficient for a person to manage their finances. So we're building that infrastructure to make that really seamless in a wallet at even the smallest amount of transactions. So that's what DriveWealth basically does.
All right, Gil.
Hi, so I'm Gilman Disease. About 20 years ago, I started my first fintech. I guess it wasn't fintech yet, but startup. It was backed by Sequoia Capital, and it was basically kind of the Visa network for large institutional foreign exchange trading. After 7 years, we sold it to ICAP, an international company that later on was acquired by the Chicago Mercantile Exchange. And then I stayed there another 8 years, ran electronic platforms there, and we met over there as well. And about 3 years ago, left again to start a new company, Capitolis, which again is backed by Sequoia and by now Index Ventures and Spark Capital as well. At the core of what we do is basically the realization that the entire industrial logic of what is an investment bank in the world of capital markets was basically rewritten by regulators. So everything that about 10 years ago on the back of the crisis. So everything that led into this crisis for 600 years of what is a bank, which was in essence a big balance sheet that was extended to clients, so to counterparties, can no longer work. And we're trying to basically reinvent the logic of the industry with an Airbnb-like model for capital. So I'm happy to expand on that, but that's what we're trying to do, basically separate the servicing from the capital and create a marketplace for the capital and financing in capital markets.
All right. Nick will introduce himself when he comes. So, as I was waxing lyrical here on what you do and how I'm much more excited about what you do in your respective spaces than a lot of direct-to-consumer fintech propositions, right? However, nothing is all
we
rosy.
agree, I think.
I'm sure that you agree with me, right? So, however, not everything is so rosy, right? So, on the direct-to-consumer side of things, you have an issue with basically scaling and getting as many customers as you can, right? The cost of acquisition is extremely important for your success. It's very difficult to navigate these waters. Distribution is an issue. And many fintech startups, specifically in the first waves, have floundered just because the cost of acquisition killed them, right? On the other hand, here you are. You're dealing with way more complex workflows and processes, where compliance and regulation and risk are probably, more difficult to kind of grasp, and where you have to work in collaboration with other actors, right? It's not like direct-to-consumer where you have the direct access to the consumer. It's all the different third parties or collaborating competitors that you have to work with in order to change a specific workflow. That's very difficult in and of itself, right? Long sales cycles, implementation is not that easy. So how do you cope with that complexity in order to get to scale yourself and avoid the same fate that many direct-to-consumer fintech startups with their own problems, encountered?
Right, well, the B2C space is really, it's evolved, it's highly focused on user experience, right? So what we've seen over the years, I mean, early on when Robinhood sat on a platform and moved off and built their own, that's becoming less and less likely today because of the fact that when we have this whole move towards zero commissions, free trading, all that stuff. And we don't even like to really talk about trading because we think it's really becoming about more investments and saving. So for the B2C guys, it's definitely really high focus energy around user experience, which makes it easier for people like DriveWealth as we build out our infrastructure. And obviously, who are your competitors? Well, our competitors are really still the legacy players around the world, right? I'll give you an example. For instance, E-Trade has 2,600 different systems running their E-Trade platform. Half of them probably don't even run today, but they're afraid to pull the plug because they don't know other systems it affects. That's the interesting problem with the legacy infrastructure. So for us, we just realized we had to start from scratch, right? We had to start building from the ground up. It had to be API, obviously, driven. APIs were basically a way to move the data from one place to another, but now they've really evolved in where they have actually real working functions within those APIs that can do really cool stuff. Like, for instance, notional trading, obviously moving money and things like that. So as this business has evolved, obviously, especially in the brokerage space, unlike the banking space, the brokerage space is really complicated in the sense that look at how the players, you have the onboarding players doing AML, KYC, you have people doing tax reporting, you have people doing, real-time, obviously, accounting for it, custodianship. So there's a lot of parts to brokerage that really were creating a lot of inefficiencies in the pipe. And we've basically sought out to basically straighten out that pipe and make it very efficient. It's hard being a startup in the infrastructure world, right? Because you don't have that B2C metric of how many clients you have, how much money you spend, what's the cost of acquisition. For us, it's really you're building a lot of infrastructure at cost without any clients. And in a regulatory environment, you need to have the regulatory license to actually operate. So then you've got to go get those and then integrate into the custodians. It's a long, arduous, costly process. But again, at the end of the day, our whole thing is this is a global trend. It's rapidly growing. Just this last couple of months, last year, 4 new neobanks in Mexico have popped up. So for us, we're starting to see a real, bridge between not only the legacy players waking up to what's going on. Digitization's been going on, as I said before, for a long time. It's no more longer about that. It's more now about embedded finance, and we can get into that a bit more. But for us, it's been a long process to rebuild all the building blocks to basically run a infrastructure so the people that we work with can focus on the product and the customer.
Yeah, so completely agree with your points. And this is a much longer and more arduous process. The good news is, when you're successful, this is a humongous industry, and it's not nearly as competitive as you're looking at others. So it's a very sticky business model. So it's worth it, but one has to understand, we're dealing, just to put things in perspective, last year, that just ended, was our first sort of real production year. And between about 50 of the world's largest institutions, we moved about $2.5 trillion, that's with a T, positions. And we would expect to grow, I don't know, tenfold or so this year, and this is just the tip of the iceberg. But for people to start trusting you with such huge positions, these are the largest institutions in the world, these are the most intimate relationships to very serious businesses, it will take time. It will take time to sell, it will take time to be onboarded, it will take then time to win the share of wallet of the client. And to your question, what does it mean? It means that you need to know what you're doing. And there's not a lot of, it's not a sister company of ours is Lemonade and e-insurance, super successful company. The founders of Lemonade were not insurance people. Another sister company of ours is Robinhood. The founders were not equity investment people. In our space, you need to know what you're doing. At least some of us need to know what we're doing, at least historically, and then you could complement with people who are just startup or technology people. And you also need to understand it's going to take a lot of time, it's going to be expensive, and you need to make sure that you have the right investors and the right partners that are going to take the business very seriously. You cannot afford to make big mistakes. Big mistakes are going to kill you in this business, and there's not a lot of second chances, and you need the right set of investors, the right set of founding team, and then it's just about just long-term execution.
One of the thoughts that I have when it comes to certain parts of financial services, most notably capital markets and the institutional part of that, asset management, which percolates all the way down to the retail side, right, is that we're dealing with political utilities. The political aspect is extremely important, right? Banks are systemic animals. Agents and actors, centralizing agents and actors in capital markets are essential from a political and nation-state point of view, or trading blocks point of view. And so it seems to me that you're, on top of being a startup that scales, right, your end goal is to become that new utility that does something bigger, better, with either as many of the traditional actors plugging into you, right? Or like architecting with the new actors. And so you don't have the freedom of like breaking things at pace that a typical Silicon Valley startup has. You have to play nice with the existing system and provide operational efficiencies within a certain framework. Because else, someone is going to come to you very quickly and say, Gil, Robert, no. We should retire you and you should do something else. So how do you include that in building and scaling your business?
Yeah, no, that's a great. It's painful. You're right. We are, in a sense, we are treated like and thought of as a utility, right? We have to be there every day and every moment of the market. People are moving financial transactions all day long. It's got to be instantaneous. It's got to be efficient. Customer needs to have a response in milliseconds. So, there's been a lot of things in terms of technology that's helped us. Obviously, the cloud has been a tremendous advantage, right? Because one, not only does it give you scale, but it gives you security as well. And you can do it globally, right? So there's pods around the world that can do that. So obviously, we've taken full advantage of that. And obviously, with new systems, we've really learned. This is not the first, I built an FX platform back in the early 2000s. Same issues, right? How do you do cybersecurity? How do you do scale? And we've learned a lot along the process. As Gil was mentioning before, it's a long, arduous learning curve. You can't make a lot of big mistakes. You can make a lot of small ones, but you've got to correct them very quickly. So for us, using modern technology today has been helped us scale. And I think, you know, that's what's, you know, creating these legacy players to start to look at digitization as a necessary evil. And they can't, a lot of the players that we're now bridging on the legacy side, they're just doing fencing off and doing projects off their old legacy infrastructure because it just doesn't support it. So yeah, we are becoming the new utility for the brokerage and investment space.
Yeah, so I think it's definitely, this is an industry that needs to be handled with great care. And it needs to be handled with great care because this is the industry that truly makes, like if you think about capitalism, this is the industry that makes it all possible. And it cannot break, and the trust in the system cannot break. And there has to be a deep appreciation for the role that both the banks, the utilities, and whatever it is we're doing, how it fits in the overall system. And hence, when I hear people talking about, for instance, blockchain replacing CLS or DTCC or those industry utilities, these are just laughable notions that only people who are coming from Silicon Valley and think that, okay, this is Uber, so it's going to work, it's not going to work, who cares, we can forget about the regulations. This obviously has been very successful in other places. In this industry, it's just a laughable notion that is just not going to happen. It's not that it's dangerous, it's just not going to happen because regulators are going to stop that. And in that sense, there needs to be not just, you know, to me this is exciting. It's exciting. We're working with the regulators. The banks are thinking not just about whether it's going to work or not. From a reputation perspective, does it perceive to be something that we're just looking for a loophole in the new regulation, or are we really trying to implement what the regulators wanted to do, the new, making sure that there's never another bailout of a bank? This disruption that on the one hand would make a lot of good things happen, but if we're starting to think about pension funds and asset managers starting to be effectively the outsourced balance sheet of the largest banks in the world, you need to make sure that this money actually is going to come back to these participants, ideally with a meaningful return or superior return to their current alternatives, et cetera, et cetera. So the responsibility aspect of dealing with the world's one of the most important infrastructures is something that has to be at the center of what it is we're doing. And to me, this is not, yes, it represents challenges, but it is very exciting to be part and a constructive and positive part of it.
Yeah, no, Gil makes some really great points, right? Because the regulators, by definition, are very slow moving. And as new products come to the market, they want to rely on old ways of doing things and what they've done in the past to put new regulations on those new products. So and the other challenge they're facing today, it's global, right? Money's moving around the world at the fastest pace ever. Right? So they're very concerned about what's the local regulations versus a foreign regulation, putting those together, dealing with those. For us, we have, you know, customers in 150 countries. So how do we deal with the fact that local regulations, how they match up with U.S. regulations if someone wants to buy a U.S. securities product, right? So these are all things that not only we're struggling with, but the regulators struggle with as well.
For the two of you, do you consider your markets or your market to be global? Or are you segmented
Definitely.
in one particular country?
This is an amazing digital. I mean, the idea of the digital wallet. I mean, I think people are starting to understand what it really means. It means really embedded finance in a wallet for an individual to basically become much more efficient and much more engaged in their financial life. Right, so basically, you know, we see people matching consumer behavior now with investment behavior. If you're an avid latte buyer at Starbucks every day, you should probably own Starbucks. And we see people, like we power Square, for instance, and now they come up with programs where someone buys a Starbucks latte, they get 50 cents worth of Starbucks stock. It's really trying to cross the engagement. It's financial literacy at its finest because people are actually engaged by their activity on the consumer side. To really they know they have to save. They know in their minds that the future, to have a good, you know, they want to live today, but they also know that the future needs to have some kind of financial plan, right? And I think that's what these wallets are doing. And then the real interesting thing is, like, talk about global, right? Think about one of the biggest announcements, I think, recently, the Uber wallet. Uber is known to be a logistics company, a taxi company, or whatever you think about it, moving somebody from one place to another, goods. But the Uber wallet, what does that mean? I mean, that means they're basically getting involved in finance. That's why I meant before about embedded finance, right? Everything people are going to do natively and touch through a wallet is going to become more efficient through AI and things. We're just going to make people much more efficient in the way they run their financial lives.
So yes to global. You're going to say yes to?
Yes. So our market is definitely global. We have offices in New York and in London, and the bulk of our business is certainly, I don't know, 85% of our business is being done with banks that are and investors that are domiciled there. But the business is certainly global. This year, we're going to grow meaningfully. I'd say for the rest of Europe and North America and Australia, sort of the rest of Asia is later on for us, but it's definitely on the map.
All right, that was a setup question for my next question. So I don't think that many people will push back on what I'm about to say, right? It seems that we have reached the end of a certain way of globalizing, right? That like hyperglobalization has shown its limits, and I will even venture to say that it seems that we're towards the end of the current global financial system that we've been under since basically Bretton Woods, right? So what comes next is up for debate, but directionally, right, we may have 2 to 3 competing global, well, sub-global financial stacks, right? One which is still US dollar-led, one which may be, EU-led if the EU doesn't screw things up, and one which is way more Chinese-centric. There might be a couple of other sub-ones. Does the Islamic world come up with its own stack? I don't know, right? So 2 to 3, maybe 4 or 5, right? Where data protection of your sovereignty with your currency, as well as with your own political utility for your capital markets and so on and so forth, is way more prevalent than just like there's a layer and it's completely global. So if you take that for a second and noodle on it, what does that do to your businesses with the technologies that are essentially, horizontal, serving pretty much everyone? Does that force you to rethink your approach in terms of like, okay, there's going to be a balkanization and we have to customize here or there, or we'll only focus on one stack? I know it's a little bit science fiction-ish, but I mean, it's fairly close to us. Who wants to start?
I'd say not what we're seeing, right?
Okay.
I'd say, I think that's true for the US, Europe, much more developed countries, obviously, in their financial systems. But the things that are happening, evolving on a global trend right now, for instance, that we see, is these are countries that never had access, or at least affordable access to these investments ever before, right? So we see it as a total greenfield. Right? I mean, you think about the emerging markets and the new affluence. Think about India, for instance. We've seen more money go into Latin America over the last 2 years in terms of investment, where it was basically not even trickling in 3-4 years ago. So these are new markets that are having, for the first time in their history, access to global markets and diversifying through their different portfolios that they never saw before. So I see why in the European markets where the sovereignty and all that is more of a concern, but for the global markets, they want their citizens' stuff to be global in perspective, but also know that the most efficient, most growth-oriented markets, especially like where the U.S. is today, it's important to have some exposure to those assets. Especially with an interest rate, environment where I think this trend in lower interest rates has been going on for centuries, not just years or decades. And I don't think that, we may have peaks and spikes in interest rates at some point due to political conflict or something like that. But the trend is lower. I mean, negative interest rates in Europe. But people are looking to place assets where they can get return. And I think that's a global phenomenon, and people that are having the access to it before, this is a brand new thing. So I think that global piece is very intact.
Yeah. So I thought you're going in another direction with that. So I think, first of all, I agree. I think that the system, so first of all, we love complexity. The more complex, the better it is. So we love new regulations, new complexities, everything that, where there are points of friction that we can then help address is fantastic. But also the interconnectedness of the global markets and the capital markets are as intact as they ever were, if not more. And as a result of that, we do not expect that that would have a huge impact on us. I thought you were going elsewhere with that, which is fundamentally, if you look at what happened, around, say, Barclays or RBS, is as the British population and government decided to, basically bailed out the bank, the regulators in the UK said, well, we are not in the business of extending derivatives and taking risk on other countries. So what happens is that the largest banks in the world, congratulations for whatever it was. So where I thought you were going with this is that the largest banks in the world will extend and will have less appetite for local markets.
I was not going in that direction. No,
but I do think they will have, and they do have less appetite from a credit and capital perspective to the local markets, while they have platforms that are severely scalable. And where you will see, therefore, the more specialization is, we think that the local banks will focus more on the extension of credit,
I see.
Whereas the global banks will provide the infrastructure.
Nick, we have a lot of catch up to do. So
apologies.
That's quite all right. So why don't you introduce yourself and tell us what RTGS is doing, and then I'll catch you up with a couple of questions that you'll have to answer, because Robert and Gil answered those already.
Oh, great. Okay, that makes my job much easier. Firstly, apologies. We're in France, and so they divide you in half between two different stages at the same time. RTGS is a new company. We started work on it last year following, some of you may know, I founded a bank in the UK called Clearbank. When we were building Clearbank, which was the first new clearing bank in the UK for 250 years, I got exposure to the global infrastructure, or the global spaghetti, that is effectively the way that the financial markets and financial systems operate. One of the things that I realized going through the whole authorization process was that we were building a brand new bank. We knew how much money we had in our bank. We knew what our liquidity position was, but we didn't know what the counterparty liquidity position of the banks we wanted to work with. And so every transaction we do with another bank, we take risk. If you go back in banking history, there's a thing called Herstat crisis that happened in 1974, which was a precursor to the global financial crisis. So when we looked at this, we thought, this is really very, very silly. There must be a way, given modern technology, cloud computing, to build a system globally so that we could identify and confirm liquidity against every financial transaction that exists on the planet. And in discussions with the World Bank and the IMF on this, we found out that the friction that the world's spaghetti creates costs the global economy $15 trillion a year, which is a huge amount of money. It's about $87,000 a second in delayed payments. And if you think about taking half of that and putting that back into cash flow, it's the single biggest investment that we could make in the global economy that actually costs us nothing to do. So RTGS is building a new platform. We do real-time liquidity management. We have a pilot starting in June of this year. We have 44 global regulators, 460 commercial banks supporting a pilot. We're going to run through a pilot, see if it works, and then during 2021 and 2022, roll that technology and that platform into the marketplace. And the benefit for you would be that on a Sunday afternoon in Paris, you could make a payment to a business supplier in Australia in 300 milliseconds, because that's what the platform is doing today in its pilot mode. And so the immediacy of payment means that the business you're paying in Australia has that instant cash flow advantage, so you have the appreciation of the value of the transaction. And it's ironic that today, that to do that same payment, it's faster to go to Charles de Gaulle Airport take out a bag of Australian dollars and get on a plane than it is to wire it through the international system. So that's what we're trying to fix.
And what does RTGS stand for?
Right, we're very, very, RTGS, if you're in country, it stands for real-time gross settlement. And if you're us, it stands for real-time global settlement.
Oh, that was one of the last questions that I loved at Robert and Gil, which was global or not global. So the first point that I made was what you gain by not being a direct-to-consumer business, which is not dealing with the cost of acquisition and scaling of retail clients. And many fintech startup has failed on that, right? Yeah. What you gain on that, you also gain on the complexity that is B2B, either capital markets, workflows and processes, or asset management, or global wholesale institutional payments, right? Most of these businesses are quasi, quote-unquote, political utilities. They're like very, very important for either a country or a group of countries. So you have, you have to pay an extraordinary amount of care in building what you're building. You also have to collaborate with a lot of incumbents, either commercial or regulatory and legislative and so on and so forth. And so you probably have a very long tail ahead of you in order to grow and scale. And how do you approach that? Because you're still a startup and you still have to, you still have to grow, quote unquote, fairly fast in order to succeed.
Yeah, we're quite lucky. One of the things that I've been very successful in my career because of the teams that we have, and it's not me, it's everybody else that does all the hard work. And sort of having a number of achievements behind you and having built a bank, the first new one for 250 years, gives you the ability to go and actually kick down doors. So how do you do this? I spent eight weeks before Christmas flying 46,000 miles, going from regulatory meeting to regulatory meeting to regulatory meeting. I don't recommend anybody does that. It's not good for your health. But if you want to make a change, you have to create inertia. And so the conversation we had with the regulators is, this is the problem, this is the solution. We know that you can't say yes, but we hope you can't say no. We don't want to engage with commercial banks without your consent. Will you allow us to engage with commercial banks and we'll keep you informed with the progress, or would you prefer that we don't do this project? And we had 44 green lights from the Bank of England, Federal Reserve, et cetera, et cetera, et cetera. And so the long tail got chopped in half. All right, and so we were done by the end of last year in relation to all of the contacts we needed for all of the work we need to do in 2020. Now, that might sound as though that's brilliant, but we have to do all the work and execute in 2020. So our biggest challenges have been building the tech platform to do this. So we've been working with Microsoft. We can now run about 36,000 transactions a second on the test platform, because this system has to be hugely scalable. And we start with the G7 countries at the end of June. We go into the G15 during August. And by the end of August, we start to introduce the regulators to that. By the end of the year, we'll have the G50 currencies running through the platform. We know that we're going to face a lot of hiccups. What we're doing is called atomic settlement. And so, when you make a payment today, it follows the sun. When you make a payment in the future, it goes to the person who's expecting it. So you have a unique anomaly that if you're an Australian business paying a US company on the West Coast, you pay them a day early because it goes over the date line. So there's a number of very interesting operational challenges that lie ahead.
Last question that I asked Robert and Gil, right? It was in the form of an assumption. My assumption is that we are towards the end of the global financial system led by the dollar, as we have seen it since basically post-Bretton Woods, right? And that even though we don't know what is coming next, directionally, it might be that instead of having one global system led by one currency with like one set of plumbing, right? And when I say one set of plumbing, I'm being a bit facetious. Towards a splintering with 2, 3, or 4 trading blocks that have their own financial stack, right? And with some type of bridge between themselves. So my question was, if we're going towards that, how does that challenge you, and how do you basically mitigate as well as design for that new paradigm? Now, Robert and Gil said that I'm completely wrong, and they said that it's going to continue to be global, so that's at non-issues. What say you?
I think that sometimes you actually have to go and talk to customers, and I think that one of the failings of many fintechs is they look at the tech and they forget the customer. If you go around the world, if you go outside here to a restaurant and you say to everybody, stop eating, right? All of those of you with a cryptocurrency in your pocket, put your hand up. You're going to be very disappointed by the response. 99.99% of the world's population understands their domestic fiat currency. Right. The reason I believe that cryptocurrencies have moved forward and why there's this desire to try and create alternative reserve currencies is because interoperability of fiat currency is part of the friction challenge that we're trying to address and are now addressing within RTGS. If you can have instant interoperability of fiat, right, then that starts to change dimensions a lot. I was talking to Gaston Brown, who's the Prime Minister of Antigua, about the challenges that the CARICOM region have in relation to being dollar-reliant. And they're dollar-reliant because of a historic fact, not dollar-reliant because they choose to be. So if you rebalance so fiat can move real-time, all right, yes, you may end up with certain economic regions choosing to have a currency that they can rely upon rather than it being a reserve currency. And in relation to our network, we're currency agnostic, and there's 180 currencies in the world. So if Mark Carney decides he wants to invite and create, the Carney dollar, good luck to him, we'll run that as well. It doesn't matter to us what currencies exist. But what I think does matter is the currencies that make an influence on the consumers and the business owners. And I don't see that these 3, 4 different currency blocks really change the market in a way that changes the business.
Fair enough. Any questions? We're almost time's up. A brave soul raising their hand, asking a question to panelists? No one? Well, thank you very much to the 3 of you. I really enjoyed the conversation. It was great.